welcome to the Inner Circle Boardrooms Backstage Pass. If this is your very first time here, a very big and warm welcome to you. My name is Kay Chohan. This is the platform you'll find me in conversation with investors, founders and boards. I'll be unpacking their views on the economy, shifting operating models and the latest investing strategies. Also bring you the latest thinking into the market gaps and opportunities. Delighted to have our guest on today to come and join me. Tony, you're the Group CEO of Healthcare Management Solutions. You've been an owner, an operator. You guys have a very unique business proposition whereby you work with banks, insolvency firms and private equity. And you guys offer management and turnaround services. I know that you guys, in terms of your unique proposition, you don't have a lot of competition saying that, which we can discuss in a bit more detail. And I know you guys are leading providers with something like 3,500 beds, just shy of. And so I was very keen to get your insights around what you see and usually where it often goes wrong for businesses. So with that said, for the sake of our audience, please could you introduce yourself and a bit of background about your firm as well?
Hi, Kay. Before we start, let me just say I'm so looking forward to this. Yeah, Tony Stein. I'm CEO of a company called Healthcare Management Solutions. And whilst I'm a chartered accountant by training, I would consider myself to be a care home operator now, dyed in the wool. Been doing it for the last 20 years. I think it's something I'm pretty good at. We've got a really good team behind me. We've got a business proposition here, which is very focused around care homes and the care sector and all aspects really of the business. So from professional outsourced management solutions, audit and inspection, systems and consultancy work. So pretty much a wide range, but focused in a fairly small area.
You've got a bit of a diverse portfolio there. Yeah. I want to kick off by understanding what sort of conversations are you having with some of your existing portfolio asset owners, the banks and the PE firms?
Well, at the moment, you can imagine these conversations are pretty crazy. We've had probably, well, it has to be the strangest year in the last, 25 years that any of us have ever known. There've been so many massive shifts in different variables that it's very difficult now to predict accurately where things are going to go and by when and so on. So, and as you know, investors want certainty more than anything else. And that's something that's been very difficult to deliver. And the interesting thing, Kay, is I think what's going to come out of this at the other side, because if you think about it, everybody's continuing to want to do business. There's loads of money out there waiting to be invested, and the care space has been really attractive. It's become more attractive, I think, since leisure, retail, office space and everything else has been hammered for this past sort of 15 months. So healthcare has been very high on the agenda. There's also the demographics at the back of this, which are compelling. I think it's something like by 1998, 1 in 4 people were over 65, and by 2038, so 1 in 6, sorry, in 1998, and 1 in 4 by 2038. So you know, there's an aging population, but it's aging quite significantly, and it's happening quite quickly. So that's another compelling reason for investing in this space. So there's a lot of money parked there waiting to come in. But I think as we come out of the sort of COVID period, what we're going to find is that when people are looking back to the financial trading for a lot of these assets that are being shifted around, what's happened over the last year and a half is going to seriously distort some of the numbers that people are looking at. And it's going to be really hard unpicking this. Which I'm sort of been playing around with actually internally about how we can do that, because when people ask us, you know, what's been the trading history for a certain asset, the way that it's been accounted for over the past 15 months is actually almost impossible to understand, because a lot of the money that's come in is compensated for increased payroll costs or lower occupancy, but trying to sift out which bits have gone to where in the P&L is very difficult.
What are you thinking about when you see some of the portfolios that you're looking at the moment? I mean, again, we're talking about fudge numbers there.
Well, it's interesting. So when if you want to go into these numbers, you want to look back to sort of 2019 and before that, because I think coronavirus, COVID hit us so hard and so quickly. There's a very nice straight edge almost December, January, 1920. That's the sort of cutoff, and then thereafter we started to see the impact. So if you wanted to look at what was happening or what is happening generally as a sector trend, you've got to go to that point and look backwards. And I think certainly our experience of running services was showing us that there were some big obvious trends in the marketplace. So, and I'm talking now about residential care settings, so nursing, residential, that sort of thing, but actually, live-in accommodation, residential care. So you've got two parts of the market. You've got the private pay part of the market, and then you've got the largely public pay part of the market where the local authorities and CCGs are funding care. And in the top end of the market, you've got a lot of money chasing development and acquisition of services that meet all the new sort of, if you like, sector accepted specs for high level care. So, large bedrooms, 16 square meters or more in some cases, with ensuite wet rooms, with cafes, with hairdressing salons, with cinema rooms, etc., 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 good day space, and that sort of thing. And those are focusing very much in on the high wealth areas. They're looking for a very high percentage of private pay with care home fees of 1,400 plus. That's the sort of focal point for that, and lots of money doing it. And the value of those assets is just getting higher and higher. And to some extent, it's becoming in some areas particularly, so competitive that actually it's working against the operators in those marketplaces. At the other end of the spectrum, you've got largely public pay, and in the public pay part of the market, the margins are getting squeezed for different reasons. It's not competition. The margins are getting squeezed simply because the people who are paying us, the local authorities, have got no money. A lot of them are, teetering on going bust. So what you've got is that year on year, they're putting up fees by 2%, something like that. But our costs are going up exponentially. So, and the costs are being driven by lots of things, and not just pay rates, and pay is important because fundamentally it's the largest proportion of what we spend our money on. So what we're seeing is that regulatory requirements, demands on operators are increasing every year. More training, more activities, more documentation and reporting, that sort of thing. And so all of that builds. And so what you end up with is having to employ more people. You're having to put people in for more hours, and better systems employed, better IT. All of those costs keep going up. But margins, we've experienced, bizarrely, and I was just checking this out a little bit earlier in anticipation of our chat, we were experiencing, we're becoming more and more efficient in a drive to try and achieve that. So our margins, gross margins, were actually creeping up year on year, 16, 17, 18, 19. Year on year, we were just squeezing another maybe 1% out of it. So there was a shift, but actually, I think a lot of operators, unless you're operating at really high occupancies, they were struggling. They're really struggling to make it pay. And you've got to remember that a lot of them are fixed into deals, financial deals that they'd done many years ago, and in expectation of probably better margins and better performance. So there's a lot of what I would call the walking wounded. That was an interesting sort of dynamic that was feeding through. And I think the banks, lenders, landlords, all took a step back last year. They said, right, COVID, coronavirus, there's all sorts of stuff going to happen here. We're not quite sure what it is, but let's not get too quick on pressing the button on enforcement or recovery action. We'll step back on that. And they've stepped back. And actually what's happened is the government's thrown so much support into the sector that we're now seeing a lot of those businesses are actually turning a profit, a reasonable profit, for the first time in a long, long time. And that's sort of staved off the inevitable. And I think the expectation now is that for a lot of those businesses, they've had a year and a half of reasonable money. It's not been too bad. But actually now, once that government support is withdrawn, well, who knows is the answer, because if you think about it, the pipeline of the elderly coming into those services is now diminished. So how long is it going to take for occupancy to recover? They were struggling before, so now occupancy is roughly 10% below where it was then. So that's another pressure on them. And the question really is, you know, how are they going to survive for the next 6, 8, 12 months? Are they going to turn it around? You know, are they going to get back to paying their way? Are people going to have to start to enforce because there's no other solution? And that's where I think we're getting to the difficulty. What I've noticed over the past 5 years is that most lenders and investors have been pushing hard to see a consensual sale process to get out of their exposure, rather than a formal insolvency process, because that sort of damages value and is expensive. But actually, I'm just wondering now, how many are going to say, well, you know, it's going to be very difficult to go through that consensual sale process if suddenly the rug's pulled out, we're 10% down on occupancy, and how's it going to be funded and all the rest of it. So yeah, it's a very interesting dynamic, really interesting dynamic.
There's a lot you said there that needs to be unpacked in itself. But I'm going to sort of shift gears a little bit, and we're going to come back to some of this as well. So where do you think it often goes wrong for operators? For someone with your servicing model, which when you're required to step in and deliver change, where do you see the fundamental problems?
2 areas that we always see are either financial structure or operational performance. And on the financial structure, you know, it's fairly simple. You know, they're either over rented or over geared, and it's just not working for them. And there's almost nothing that they can do with the dynamics of the business to actually fundamentally change that, unless they go back and do a restructure with the existing lender. If you're over borrowed, that's very, very difficult to do. And if you are leased at the wrong price, if you like, so the values were set too high and the rents were set too high, it's very difficult to do without somebody taking a knock at some point. So there's some work to be done on the restructuring side, I think, for definite. But the operational side is a little bit more nuanced, to be honest. It's more important now, I think, than ever before, that operators invest in the operational infrastructure within their organizations to meet today's really rigorous standards and the scrutiny that they're under. And I think a lot of operators are just not geared up for that. One of the things that we've seen a lot of in the last year, and actually you'll have read quite a lot, actually, I'm sure, in the press. There's been an awful lot of what I would say criticism coming out of the sector towards government about guidance and the way that the coronavirus pandemic's been handled is a good example. And when you actually unpick what's really gone on, I think it's actually in some cases, not every case obviously, but in some cases it's been that the operators have not had the capacity and the skill set to navigate through what has been a very, very challenging 12 to 14 months. And I think that it sort of reveals the cracks in the sort of thinking, which is, you know, there's a lot of people out there who think they can run care homes, and they were running care homes 10 years ago, 15 years ago. And actually the world has moved on dramatically. You know, running a care home when I first came into this sector was just like weird. I mean, people were running the entire business off a bank statement and basically keeping their fingers crossed that everything was going to work all right. Now, you know, you've got people who give you no quarter. You know, you're inspected and regulated, and rightly so. And you're expected to produce evidence, and you're expected to produce risk assessments and care plans that make sense, and you're expected to give guidance and training to your staff. Again, all of this I completely, you know, is right to do. But the people who were running the homes before don't have the structures internally to deal with that. So, you know, that's where we see it go wrong. You know, it's management systems, consistency, and the capacity in the management team to be able to interpret that and push that through the team.
Interesting you say that, because you almost see a bit of an opportunity for providers like yourself to be able to consolidate. If these smaller cluster players outsource functionalities, then I wonder if that could make much of a difference from a head office type cost base, even looking at compliance. And do you think that could shift the needle for some of these guys?
Yeah, I think you've nailed it, absolutely. And I think that the only way forward, if I'm honest, for operation of homes, certainly at the public pay part of the market, is to have an operator who has got the wherewithal, the experience, the expertise, and the framework to operate these both efficiently, and that's the real point. It's got to be operated highly efficiently, but highly effectively. And you need a structure to do that. Bizarrely, you would think consolidation is the way that the sector is going, but at the bottom end, actually, it's fragmenting. And it's fragmenting because a lot of people are looking at this care sector as an opportunity, but they don't have the money to be, if you like, playing at the top end of the market where you're paying £200,000 a bed. They want to be paying £20,000 or £30,000 a bed. So they scrabble together enough money to get into care services, but actually don't realise that you actually do need that structure in order to do this effectively. And so I think there's an awful lot of small operators out there at the moment that genuinely are going to struggle over the next 5 years.
What are some of the impact and implications you anticipate we can expect to see, particularly within the next 12 months in the care sector? What do you think operators are not prepared for, in your perspective?
Well, I think, not prepared. I think, first of all, the regulators had to back away for 12 months or more. They've not been in the services. What they have been doing is they've been doing some remote monitoring, and then they've been doing some infection control visits and so on of late. But I think when they get back into this, they'll be coming in and digging around and looking at how operators have been managing to run their services throughout the pandemic. And I think those that are not prepared and don't have the evidence to demonstrate what they've been doing, and maybe even in addition had a significant number of deaths in services throughout the pandemic, they're going to really, really struggle to justify what they've been doing. I'm a bit of a lone voice here, Kay, in the sector. There's a lot of people out there that have put the blame effectively for a lot of the deaths in care services at the hands of the government and the NHS for pushing untested people into care homes. And I just don't buy that argument at all. I just don't buy it. There's 2 or 3 reasons I don't get that. One is, as a care home operator, we have a legal obligation only to accept people into our care that we know we can safely meet their needs, where we know they can meet their needs. And if they felt that they couldn't meet the needs of those people coming out of those hospitals into their services, they couldn't effectively barrier nurse them, they couldn't isolate them from the rest of the cohort of the residents. If they couldn't manage that well, they shouldn't have accepted those people in. They shouldn't have done it. That's on them. That's not on the CCGs, so it's not on the hospitals, it's not on the NHS, it's not on anybody. And then I hear people saying, well, we were pressured into doing it. Well, I've yet to see any evidence, and I've never seen it, where somebody has said to me, Tony, you have to take these people into your service or you won't get any further placements or whatever it is. And had anybody threatened me in that way, I think I'd have called them out publicly, and that's not happened either, so, there's a bit of an issue here for me. I also think, let's face it, on a wider scale, leaving people in hospitals that we know are going to get acutely ill COVID patients, as opposed to moving them out into care homes where they're going to be safely looked after, isolated by people trained in infection control, actually may have saved a hell of a lot more lives in the fullness of time. But who can tell? You can't rerun the whole thing. But there's an argument either way. But I think, so I think over the next 12 months, there's going to be that. There's definitely going to be lots of coronial inquiries. There's going to be lots of legal firms pursuing claims, and I think again, care home operators are going to have to be ready with the evidence to show that they had the right PPE, they had the right trained staff, they did everything according to guidance. Otherwise, some of those claims may find themselves, being settled or being successful. So there's an awful lot of that to play out. So it's going to be an interesting 12 months.
Really interesting point you say there. But question on those claims though, and we've seen this with the airlines, for instance, where they've sort of said, well, sorry, we didn't underwrite for something like COVID. Do you think the claims thing would be the same for insurers? I mean, I can't imagine insurers are going to want to pay out on that. So,
there's a number of issues here. There's so many bits and pieces to this. I mean, firstly, can I just say publicly, I think the insurers have behaved appallingly badly over the last few months. Insurance premiums have gone sky high, and the cover for transmissible diseases has just disappeared. And when asked why the premiums are going have shot through the roof, it's always been in anticipation of claims for COVID deaths and so on. And that can't be true, because when you actually say, well, if they don't materialize, can I have a refund? They'll say no. so clearly it's just profiteering from the fact that there are very few people left in the sector insuring care homes. But I think, so the claims, it's an interesting one, because what generally will happen is, and I've talked to a lot of people about this, I don't think it's going to be easy for anybody to tie directly cause and effect. So, my mum was in your care home, you took people from the NHS into your home who were untested, she got COVID and passed away, so it's your fault. Well, we had to have staff coming in and out of the care homes, out into the community. So the COVID may have been contracted by asymptomatic transmission by staff rather than through the person who came in from the NHS. We don't know. We'll never know. That's the first thing. We couldn't practically, and still can't practically, test every single member of staff before every single shift. It's just not doable. So I think that cause and effect is going to be very, very hard to prove. But I think the problem is, when it comes to lawyers and insurers, is that the insurers will end up, if we do fight cases where the lawyers are having to be paid out, and that obviously impacts your insurance. And then there may be cases where the insurers just choose to settle where we might not want to, and again that will affect premiums as well. So I think it's not just the fact that these claims might not be successful or might be successful. It's that the process of getting to a decision one way or the other is expensive. It's barristers, lawyers, and potentially it's settlements just to clear the path. I think we've got a lot of that pain to go through as well.
Do you think care homes can profiteer from COVID from a hygiene perspective and the cost of that? Just, we're talking about inflation here, really, in theory.
I think there's a number of things. One is, again, at the private pay part of the market, I think there's an argument where you can determine what your fees are going to be. That's up to you. And I think we may well find operators who've seen increased costs of things like PPE and so on. They may well be jacking up the fees as a way of getting compensated for that. At the other end of the market, clearly we're at the mercy of the local authorities to a large degree, and the fees that they choose to pay, and that's more difficult for us. But I don't actually see any way at this end of the market, the public end of the market, where you could profit from it. We've certainly seen, as I said before, operators will have made, I think they'll have made some money over and above what they would normally have made through getting a lot of the assistance from the local authorities over the past 12 months, but that is going to disappear. That's definitely going to disappear. So, I think going forwards, this is we've had this bizarre, we've lived through this haze of, well, it's going to be 18 months by the time we finish. It's going to be all of 2020 pretty much, and then 6 months of this year. I think a lot of the assistance runs out in June time, so end of June.
So some operators will be highly geared. With banks being willing to underwrite debt to agree a sale, can you talk me through what is and isn't possible when negotiating with banks? Let's assume you've got an operator, assume the debt on that is £10 million owed to the bank. What would the bank be willing to accept and not willing to accept? Let's assume that I am hoping for a payout from that as well, being the operator. I want to know your thought process on this, because obviously you work with the banks and PE firms. What could you make happen if you were being creative, which is within the guidelines of, from a legal standpoint, but if you could be creative, what could you make possible or not?
If over the last 12 to 18 months, the support that it's had has managed to assist it through and it's serviced its debt, I'm not seeing any signs at the moment where a bank that's had the obligations met over the last 12 to 18 months looking to do anything dramatic. And I think it would be foolish for them to do that. What will happen is, I think that there'll be now a grace period if occupancies are low, and those lenders are going to say, well, actually, you're performing well before, you performed okay through COVID. We know it's going to be hard times now. So, pushing it over is not in anybody's best interests. So there'll be that grace period. But there's got to be a realistic view that the occupancy turnaround is going to happen. And personally, I've spoken to a few operators recently, and everyone is telling me that, over the last maybe a couple of months, maybe the last month, 2 months, we're starting to see the occupancy tick up very slowly. So if there are those signs, then, as I say, it's even more reason why a lender wouldn't be rushing to do anything dramatic. But if you're in a different position, if you've got a history pre-COVID of not managing to service your debt, if the bank's in a risky position because it feels you're over leveraged, then I think what I have seen a lot of is the banks, as I say, forcing people into a consensual sale process. That being the case, then clearly the bank is going to incentivize the operator to keep going and trading these things as well as they can to get the best possible price out of the end of it. So that might be by forgiving PGs, it might be by giving them a bit of a bump at the end out of the sale proceeds, but they're going to need these things to keep trading. So I think the bank will be very reticent to give away too much. The bank's got two choices. The bank either enforces, in which case it starts to incur legal costs, it starts to incur IP costs. It might even incur costs with somebody like us to come in and help manage it through until it's sold on to the next investor or the next owner. And it has to weigh all those costs up against just saying to the operator, well, okay, if you keep running these for the next 6 months while we get this sale away, then let's talk about what we can do for you to just do that, because it's all about numbers, isn't it, at the end of the
as the shareholder, because actually the first charge goes to the bank, and if the bank then finds out that this investor is going to be paying 2 million to this shareholder,
it would only ever happen if the bank was confident whatever it was getting out of the investor was actually a fair price. And the only way they're going to do that is by going to see one of the agents out there that specializes in care homes to value the portfolio and tell them what they're likely to get from it. And that's very hard to predict. But by the same token, one of the other problems that we're now running into is that if the bank chose to go a different route, so let's say there's 10 care homes in this group. If the bank said, well, actually, no, we're not prepared to accept 6 million, we're going to take these to market, they've got to, one, get them fit for market them, find buyers, get the buyers to find lenders who'll lend to help them make the purchase. Then they've got to register, which is taking 6 months-ish at the moment with CQC. And it just goes on and on. So the bank has got that to all that tortuous process. It may take 2.5 years to get all these things through a sale process in the end. And they compare that with getting 6 million quid in their pocket today. And so that's a decision the bank has to make. And I think, frankly, they wouldn't be awfully impressed if necessarily that there was a backhander going around. But at the end of the day, for them, it's a choice. It's a choice between what they can make if they get these things sold through a process, if they sell these things piecemeal, or if they accept the offer. And that's all that'll matter. They'll get somebody to go around the 10 homes, value them, tell them what they might get. They'll deduct all the costs of getting there. And then they'll say, well, we'll compare that with what your investor is offering. And it will be that simple. If the owner's introducing the investor in that case, and if he's prepared to manage these services until such time as that transaction takes place, he could negotiate a compensation for doing that. Again, it depends how much the bank's having to support that business throughout that period to sale as well. If an investor comes in, and this is one of the big things at the moment, if an investor can come in and buy the shares of the company, then clearly there's no re-registration, so it can happen quite quickly. If the business is bust, then buying the shares of the business isn't particularly attractive, unless it's only bust as a result of the bank. So the bank waiving the debt at the end is fine.
Okay, so let's talk about margins. Margins are getting tighter, and what concerns do you see when it comes to valuations and profitability of the sector? And bearing in mind you work with distressed businesses.
The concerns are clearly around how do you interpret what's happened over the last 12 or 18 months. That's got to be a key one. So if I were looking at this now, what I'd be looking at is, first of all, well, there's two or three big issues here. Certainly over the past 12 to 18 months, the numbers are going to be all over the place. So look at history, look at how it traded up to December 2019 and take a steer from that. The second thing to look at is where is occupancy today and how long is it going to take to get back to the sort of levels it was pre-COVID. And again, that's anybody's guess at the moment, but maybe 6, 12, 18 months, something in that ilk. The other thing that I would say for anybody investing in this sector is, and I see this far too often, to be honest, Kay, and we had this conversation the other day, the thing that people always misjudge or underestimate is the amount of capital required in a lot of these services to make them fit for purpose and to be tradable assets. And I've seen way too many times people struggle to get the cash together to make the initial acquisition and have nothing left to invest into often what are quite seriously underinvested assets. And you've got to remember that underinvested doesn't just mean that they haven't put some new carpets down or they haven't, painted the place in a while. It may well be that there's remedial fireworks, maybe there's electrical works that are needed. There's stuff that you cannot avoid doing in order to make the place tradable and safe. So, I've seen some horror stories in the past 6 months even where people have had no capital resource when they've made the acquisition to put the service into a position where actually it's fit for purpose. And that's distressing because actually they're already in trouble. So we talked about this before. We always work on 3 types of capital expenditure. We've got health and safety, defensive, and strategic. And all of our work is always done around those 3 areas. So the health and safety stuff is money that you have to spend in order to meet all your obligations and legal requirements. And if you don't do that, you're not trading safely and you're not trading properly. So there's a good chance you'll be closed down for whatever reason. And that's all to do with things like fire, Legionella, electrical works, gas works, the usual stuff. So that's got to be done. You then have the defensive Capex, and this is usually where the biggest amount will come in. And this is making your asset capable of competing in its asset class, in its geographical region. So, you've got 2 60-bed homes side by side, both of them offering a combination of residential or nursing care, usually with some dementia. They've got usual stuff, lounges, dining rooms, kitchens, whatever else. So they're equivalent homes. Yeah. Both of them built maybe 1990s, something like that. One of those assets has filthy carpets, poor furniture, hasn't been decorated. The garden's a mess. There's no real safe garden area. The boilers haven't been looked at for a while, so they keep breaking down, that sort of thing. And so you then have to think about, well, I've got this one down the road that's been well invested. It's got lovely furniture, lovely decoration, nice carpets, whatever else. You can't compete. And so in order to get there, you've got to spend the money. Now, I've been running these things long enough to see that it costs a lot of money to redecorate and refurnish a 60-bed care home and recarpet it. You can lose £200,000, £300,000, £400,000 without blinking. So it's serious amounts of money, and very, very few people actually plan for that properly. And then when they get in, they're so busy trying to pay the obligations to their lenders that they just can't find the cash, or they're trying to do it on 10 grand a month or 15 grand a month. It's not doable. So that's defensive. And then there's the strategic stuff, and strategic expenditure will add value. So it will give you better rooms that you can get a higher private fee for. It will give you extra rooms. You might be able to build an extension, that kind of thing. So it's actually improving the asset's position rather than helping it to compete in its current class. So yeah. But it's the perennial problem.
How should investors be strategically thinking about occupancy and returns based on some of those three pillars that you've spoken about?
Whenever we're looking at an asset, we look at three scenarios. The best, worst, and likely scenario from a financial trading point of view. So we take where we're currently sitting at, and we'll project forward occupancy and staffing costs over a period of 3 years. And we'll say, this in the best case scenario, this is where we're going to get to. In the worst case, this is where we're going to get to. And the most likely, this is where we're going to get to. And let's say we always settle on most likely as roughly where we think it's going to be. You then look at that in terms of your debt serviceability or rent cover, and then you can work backwards to, well, what's the price going to be? And to be honest with you, at the top end of the market, it can be 200,000 a bed plus. And at the bottom end of the market, 20 grand a bed, 30 grand a bed, depending. But the way that we would then calculate it is we'd say, well, the cost of, let's say we value it at, I don't know, let's say we spend 30 grand a bed. So we've got a 60-bed home, 1.8 million, something like that. Right, what's its current EBITDA? Its current EBITDA might be, let's say it's 200,000, or trying to keep the numbers going in my head here, which is quite tricky.
That's quite low, isn't it?
Not good at numbers. But so I would be saying, look, if you know you can trade the socks off this thing and there's some easy wins, then it doesn't matter if you're paying 10 times multiples, because you can get to somewhere sensible, very quickly. But I think you've got to look at it in terms of debt service. You've got to look at it in terms of price per bed. You've also got to look at it in terms of multiples, and you've got to be confident that you're not, first of all, paying for the hard work you're going to have to put in to get there, but also you're not paying to get to somewhere which is potentially not achievable. Once you've got to the value, you then deduct all the Capex for health and safety and defensive, and then that's the price you should be paying. And unfortunately, there's too many people will get to a value of 1.8 million and they'll scrabble around, they'll try and do a deal at 1.7, and then they'll think they've got a bargain and actually forgotten that they've got to spend 400,000 on the damn thing to make it fit for human habitation.
I'm very similar to you in that I take an average over the last few trading years, and I exclude last year based on just its fudge number. If the occupancy's higher, but the EBITDA is pretty much the same, then there's something wrong there.
You can use it to judge some of your previous history.
Yeah, I suppose I was just trying to find out if there's an art or a science to be able to go, okay, well, this is how you define it. I appreciate it's horses for courses on so many different variable factors.
Every single care home is totally unique business. And so, when people, if you go to anybody and they turn around and say, the current multiple for care homes is 7 or 8, then they're talking through the hat, because frankly, that depends, doesn't it? It depends what you're buying. If you're buying a hole in the ground, with a roof on it, that's not going to be worth as much as an all singing, all dancing 18 square meter bedrooms with ensuite wet rooms. The other factor that we've not talked about is how are banks viewing lending into this sector at the moment. We talk to a number of different bankers, they'll come up with different answers as always, but I think generally what I've seen is that the banks, there's a few of them that will say they're very definitely in the game. They like care homes. They're quite happy to look at care homes. Well, they're all happy to look at any opportunity, but when it comes right down to it, depends on the asset type. I think if for a really sound, modern, purpose-built, top of the range, high private fee, blah blah blah, you may push the banks to 70% loan to value. You may. I'm being a bit maybe a bit bullish. At the other end of the market, there's two things come into play. One is they're not particularly happy to go much beyond 50% generally. But also what I am seeing is that a lot of banks are now waking up to the idea that there's a very limited economic life for some of these assets now. And so the criteria for them lending is getting a little bit tighter. So, how many ensuite rooms have you got? And to be fair, you've got to be very careful when talking about ensuites, because an ensuite toilet with wash hand basin is not viewed the same way anymore as a wet room. And where's it located? What's the asset looking like in terms of day space? Has it got narrow corridors? Has it got good public amenity areas? Is there a decent garden? What about the car parking? That sort of stuff. So they're getting a little bit pickier about what they're prepared to take as security.
And we're doing some structured finance on a couple of deals. I think it really depends. And I also think it varies on the operator as well. If it's an experienced operator, I think banks do take a bit more of a risk, all about the story you tell and the way you tell that story, the numbers and the credibility of the individuals. Then I think then there is leg room on that LTV that you were talking about.
There is, and particularly private equity investors, they very much focus in on the management team, and so the history of the management team is vitally important. Their experience, their abilities, and all the rest of it. You did say you were talking about experienced operators, Kay, and I think if you've got a portfolio of 30 homes already, and you're adding another home in, then clearly the bank's going to take a slightly different view than if it's a single home in a single company that is highly dependent on how that asset trades and only that asset. That's the difficulty. And also what I would say is if you're a lender and you're talking about what constitutes an experienced operator, somebody who made a fortune out of care homes 15, 20 years ago may not be somebody who can operate care homes in today's environment as well. The world's moving on. I was going to say in 10 years, I'll be considered a dinosaur. I'm probably already considered a dinosaur. but things move along, and so, you've got to be able to show that you've got contemporary understanding of how care homes are operated, and you can demonstrate what you've achieved within the sector.
So we have an aging population. Demand for care homes is changing. What does that mean for the future of existing care homes and the future of new builds? Talk me through both models.
There's a massive growing population of older people, and to some extent it's the variables. There's so many variables out there. So what are the variables? The variables are there are alternative ways that people can make provision for their old age and care needs. They can buy something in a sort of a structured environment where there's care delivered to them, so sheltered housing or accommodation with care. They can sell their current home. They can buy something in a care village. This is very popular these days, you know. So we see these popping up all over the place. The good thing about that is that they've reinvested some of the equity in their property into some other property, so that's to be passed on to the kids, and they can buy in care as and when they need it, or people can get domiciliary care, so they can actually find care delivered to them in their own homes. Now all of those have some limitations. You know, at some point some people will require 24/7 care and supervision, and those solutions don't work. But if you think about a couple, for example, what we used to call core and cluster, where there's a care home and then there are bungalows or little flats or whatever around it, so the couple can move in, and if one of them ultimately needed to go into full-time care, they're only going into the care home that's part of the same site, so they're not far away, so they can be visited regularly, and they're not moving away from home and that sort of thing. So what I'm trying to say is, I think there are other routes to meeting the needs of these people, and so arguably you could say that that's going to impact on the numbers of people requiring residential care in residential care settings as we used to know them. But just as we've transitioned, you know, 50 years ago, there would be what we would call retirement homes, which don't really exist anymore. You know, the little villa by the sea, you know, where, you know, you've got 10 old ladies sitting there, you know, knitting, and they're all, you know, quite fit and healthy in a way, but they're all living together in a communal setting. You know, those tend not to exist in that same context. People are generally only really want to go into a residential care home when their care needs force them to do that. So they've become less popular. And so what's actually protecting the care homes that we've got today is the growth in the population of elderly people. That's what's doing it. And I think there's enough volume coming through that it's keeping the residential care home sector buoyant, or relatively buoyant, and still, you know, going despite these alternatives that are popping up everywhere. But you've also got to look at the economics of this, that for the public pay part of the market, at anywhere, you know, from as little as £511 a week for care, up to, you know, maybe £700-800 a week if you're lucky in some places. It's very difficult to buy land and build a care home for those levels of fees and still make money. So there's very little new build going in for a pure public pay play. And what will eventually happen is, as the competition piles in at the top, you know, some operators will find that they're being pushed out of the market for privates because of better quality competition, and they will start to take the public pay. And so it'll force the worst assets out of the bottom of the market.
Doesn't that depend on the location and the cost of living for those? Because whilst I agree with you, I suppose it depends on the medium of that household income, low income families, because ultimately they won't be able to afford to go into private care.
That's what I'm saying. So they're still going to need this public pay part of the market.
Yeah.
The local authorities aren't going to be able to bash their fees up significantly anytime soon. I can't see that, not post-COVID anyway.
Yeah.
And so what's going to happen is that, you know, there's a category of asset that's out there today that's currently enjoying maybe 75% private, 80% private fees. But they will gradually get forced to take more and more public pay residents as the better quality assets pile in at the top in competition.
Do you still see demand for existing care homes then?
Yes, except for right at the bottom of the market where the assets are really poor. They will get forced out eventually. They will get forced out. I think COVID's, if you like, been a stay of execution for a lot of them. But I think now occupancy's dropped. You know, times are hard. They'll find, some of those homes will find that with other homes in the area, better homes struggling for occupancy, they'll be taking the people that are available to come into the home. And it may well put the squeeze on them post-COVID in a strange way, but they've had a stay of execution.
How should you be calculating the cost and return?
New builds is relatively straightforward in the sense that you'll do your homework, you'll understand what the market's like, you might see what the local fees are going to be, and you can produce a P&L that says this is the margin that we can make, this is the EBITDA that we can turn out. And then it depends how you're funding it. If it's a sale and leaseback kind of thing, you'll find a REIT or somebody who'll buy it and lease it to you. And again, you can work out your rent based on the covenant that the covenant strength that they ascribe to you. That's fairly straightforward. And actually, the Capex on an ongoing basis for something like that will be fairly low because it's a brand new build. So you might be putting in £1,000 per bed per annum, Capex or whatever it is. With a refurb, it's much more difficult. Again, what you've got to say is, well, how will this refurb impact us? Will is what we're going to get out of this increased occupancy, or are we going to get out of it an increase in the fees? Are we going to see more privates? How's that going to impact the P&L? What's the payback on this? And I always say to people, if you can sort of work on around, it's very difficult to say this, but let's say for argument's sake, this is an asset class that I think will give you a 7x multiple. If you can invest £100,000 on Capex to deliver £50,000 increased profitability, well, 50 times 8 way outstrips your 100 grand investment in terms of your return. So, you've got £400,000 or £4 million of value, whatever it is you're going to get out of the other end of it, as opposed to the 100,000 you've invested for 400,000. So you've just basically, you're just working on what's the bump in the EBITDA going to be. There's always a return calculation for investment when you're talking about it's strategic investment or defensive investment is very different. If you're looking at defensive investment, Capex investment, the question is, if I don't spend this, what's my level of profitability going to drop to? What's the net impact of value, negative impact on value? Or is it worth spending?
Previously, we spoke about sort of annual income per bed versus fill ratio. What's the industry standard, and what are some of the challenges that you would see moving forward for operators?
We would never generally forecast a home to be trading at more than, on a consistent basis, more than say 92% occupancy. And that's reasonably bullish, I think. And what we've seen over the last year has been significantly less than that. Certainly is now. I think, what's the minimum level of occupancy? Well, in our best, most likely and worst case scenarios, I think if you can see the historic trading of the home, and it's never traded at anything less than say 65 to 70%, then you might put 65 to 70% in as your baseline. I think very, very few assets, unless you're doing something really special, are ever really going to work at sort of occupancy levels of less than 70%. I mean, we've got a home at the moment where it was registered for 40. We've now reduced the registration to 25, but we've changed it from elderly care to a different specialism, and it works because the fees are so much higher and the staffing's different.
What does it take to shift that as an operating model?
Depends what you're shifting from and to, Kay. I mean, as an elderly care home, it was a typical elderly care home. So it had, lounges and bedrooms and all the other space that you'd expect, and a kitchen and so on. We've changed the model of the care quite significantly into 3 different units, catering for different conditions. And each of those units, because the conditions that they're catering for the fees have gone from £750 to £1,100 or £1,200 a week, and the staffing is different. So it's going to be on a case-by-case basis, and you're going to have to be very careful about the care categories that you're moving to, that the demand's there. And that the building is supportive of that. It's not, again, there's no magic There's no magic to this.
So what's the art and science to lowering the cost of client acquisition and retention and to get the highest fee?
There's a lot of experience and science to this. I think art's out of the window. We are often asked by clients to give advice on not change of use specifically, but change of care category. And a lot of people over the years have tried to move away. For example, they've moved away from nursing care because nurses are very hard to come by in that particular area, for example. Or they've moved into dementia care, or they've moved into more extreme nursing with dementia. You know, again, very, very difficult areas to move into, and you need a lot of highly experienced staff and good training to manage those services well. And I would always caution people from doing that lightly. But there's certainly, and the problem with elderly care homes, what I will say is that most elderly care homes are too big and are not suitable for a lot of the specialist care categories. You know, the commissioning for those has changed dramatically ever since Winterbourne View. You know, we no longer have large hospitals, for example, dealing with learning difficulties and that sort of thing. So, you know, we're now into small 8-person, 10-person units max. So you wouldn't be able to convert an elderly unit. And again, if you think about things like ABI, you know, acquired brain injury, again, a lot of elderly care homes may not be suitable for that kind of category of care. So every single asset has to be judged on its own individual, unique situation. And we've got a lot of experience of managing all of those different services in different places. So we can then advise as to what's most likely going to be acceptable to commissioners, what's in demand in that area, and so on.
How easy is it to change your strategy from being a residential care home to going into more specialist?
It's not as easy as that by any stretch of the imagination. I mean, first and foremost, again, as a care operator, a registered care operator, you have to absolutely be certain that you can deliver the safe care in that particular field that you want to go into before you even start to think about it. And that might mean investing in bringing in additional staff. You know, for example, if you've been running elderly care homes all your life, suddenly dealing with an acquired brain injury unit would require very specialist knowledge, and you'd need to bring that in. And I think you'd need to convince CQC or CI or CSSIW that you're capable of doing that before they'd even allow it anyway. I'd hope so anyway. The whole sort of thinking around, for example, young persons' mental health services is very, very different to elderly care or elderly care with nursing. So again, you'd need to have the specialist skills. So what I would say to anybody who is thinking about this is come and talk to somebody like us. Let's have a look at your asset. Let's, first of all, if it's physically not suitable, then there's no point in you even thinking about it. If it is physically suitable, let's think about what's the best way of you getting the necessary experience within the organization to allow you to do that.
How long can it take to change that strategy and approach?
If you've got an existing trading home, the first problem that you've got is you've got an existing resident group that you're going to have to rehome. And that is not something to be done lightly. This is people's homes and it's their lives, and you know it's a significant emotional trauma for them to be effectively forced to move. So that's something that you'd have to negotiate through with the local authorities or with the relatives and with the residents themselves. And that presumably there's a compelling reason why you're doing it. It may be that financially it's not working for you, in which case, to some extent, you know, they may have an option of either moving or you closing it anyway and them having to move. So you know, there's a conversation that needs to be had. So that can take quite a while. Then, of course, you've got to put together, and you can do this in parallel, but then you've got to put together a proposal to the regulator to say, you know, this is what we want to change the registration to, and to show them, demonstrate to them very clearly that you've got the capabilities to deal with that and that they're happy to register you for that care. You've then got to start having conversations with commissioners of that care to say, you know, we're now in in this area, and we've got the facilities, and this is the service that we're going to offer, and these are our charges. And you start building those relationships and hope that if you've done your homework, that they've got people who will place with you. But I would say if you thought you could do that within a year, that you'll be going well.
The thought process that's going in my head, Tony, as you say that to me, is I'm thinking, do I buy or do I build? And buy sounds like an easier option than having to build.
You can either buy, you can build, or you can convert existing to a different use. Let's say you wanted to, let's just take ABI as an example. So you wanted an acquired brain injury unit. Do you buy one, do you build one, or do you convert something else into an ABI? Well, we've talked about conversion, and then the buy or build decision is very, well, I think the first thing to do is to find the commissioning area where you think you're going to get the business, and then look around and see if there's anything that might be on the market that might be interesting. Alternative, you've got to build, so but the barriers to entry for specialist care services are much higher. I will say that.
I suppose if there's a demand there, then potentially you could secure it on the basis that there's a demand, you can get the contracts, there's guaranteed rental, so now you just need the facility which can generate the income. Now, I'm conscious of time. I do want to get 2 more questions squeezed in very quickly. Who do you think is going to actually need to dispose or change, or you anticipate are going to struggle?
We know that, for example, publicly, HC1 have just announced that they've restructured their business, and that's under the new CEO, James Tuggendat. He's obviously taken the business, given it a great, sort of bit of scrutiny, and then he's decided that actually there are some non-core assets that need to be removed, slim it down to a higher functioning core of homes. And so 52, I think it is, assets are going to be coming to the market. So he's already addressed that, and he's done it very quickly. And then you've got other groups, Four Seasons Healthcare, I think, again, that's had a very highly publicly sort of aired past, since it changed from Guy Hands to H2 and so on. And I think, there's got to be a solution to that for them at some point. There's got to be an exit, and that exit won't be far away, I'm sure. So there'll be more assets coming to market. But again, this is not so much, I suppose this isn't so much about what's befalling people as a result of COVID. It's just a natural progression in the life of those businesses. There's a lot of smaller, independent, regional businesses that are looking to expand. And I think if I go back 10 years, I think everybody was expecting that there would be a few giant sort of groups, and I think Four Seasons, HC1, were of that ilk. People thought they would just continue to build and expand. Companies like Barchester are building, I think is it maybe three new services a year or something like that. So they're continuing their expansion. They've got a very, what I would consider to be mid to upper mid market offering, and they're very strong there. Over time they will churn out some of their underperforming assets, and they will bring in new stuff, and that's a very effectively run process for them. There are other really dynamic groups like Hallmark, that are delivering to the top end of the sector, and Avery and others, that are doing much the same. There are some I think some really interesting groups around the Midlands that are doing some really good stuff, offering a very high quality, £1,000 a week sort of mid market for the private pay offerings, and doing it exceptionally well, I have to say. And I think those are the ones that I would be watching, because I think they'll be building quite nicely over a period of time. And then there are other groups that just seem to be out to grab what I would say are questionable assets for growth, and I don't know where the hell they're going to go over time. I don't see that as a great strategy, if I'm honest. You know, that's the old pass the parcel game. It's like build something up and try and flog it on before it falls over.
Okay, so my final question, what advice would you give to a relatively new investor in the care sector? And what advice would you give to some of your peers who've been in the industry for 30 years who will tell you, I've been there, done that, I know that. I mean, what are some of the blind spots that you see, or what advice would you give to them?
I think what I would say to people is that these businesses are often run by entrepreneurs who are by nature quite optimistic, and there's a view often in the people that I talk to that we can fix this. You know, we can deliver great care. I've spoken to some very naive people over time that have felt that, you know, it's really simple. You buy something that's underperforming, you just flip it round, you add 200,000 to the bottom line, and you can do that, you know, time after time after time, and then suddenly you're rich as Croesus, you know. And it really isn't that easy. It really is not that easy. And you've got to be very, very careful about the assets that you're buying and the life that these assets are going to have, and the quality of the buildings. You know, one of the things that has almost always, I think, surprised the people I've been talking to is the sheer cost of keeping old buildings decent, trading in a decent state. You know, I keep coming back to this, but it's the one thing in the 20 years I've been in this business that's really hit me hardest. I'm seeing assets coming to the market today that I used to run back in the day, so 15 years ago. And I don't think anything's been spent on some of them. You know, they've almost got the same bloody curtains up that they had 15 years ago, you know. And when I tell you there's a lot of money to spend in some of those services, there's a stupendous amount of money to be spent in those services. And almost it's you'd have to be buying at 10 grand a bed by the time you spent all the extra money you're going to need to spend on it to make it work. So I think people, whilst there's a desperate, almost like I can see this, it's almost like a manic desire to buy assets at the moment. Be very, very bloody careful, because if stuff's cheap, it's cheap for a reason. That's all I'd say. And I think if you're talking about my peers, I don't think any of my peers would want my advice. They've all been through the mill with me, so they know what they're doing.
Excellent, fabulous. I've thoroughly enjoyed our conversation. Thank you so much for joining me. I'm going to attach your company details, LinkedIn profile, so if anyone wants to reach out, they can connect with you.
Yeah, absolutely. I love, as you can gather, Kay, I love chatting to people, and you've been an absolute pleasure always. And I look forward to our next one, whenever that is.
I'm looking forward to having you back, guys. Look, I hope you enjoyed this conversation. I know I did, and I hope you got loads of learnings from it as well. Don't forget to like, share, and comment. Let us know what you think, and we'll see you in the next video. Thank you.
Thanks, Kay.